Hey guys, DJ here from PTA. Want to go over these two trades with you, March 31st for Flex and Lgvn. Go over Flex first because I had a few people ask me about that because of the pullback that it did. Um, again, really basing everything off of price action as well as seeing the trade formulate. So I played it because it was over the 200 EMA. That was one part of the trade. Other part is the respective volume that came in throughout that day, um, that it had to do some type of pullback and a continuation. The volume had been up. I mean, you can just look over the last couple of days, going into last month. This was the first day that actually had a lot of volume, so it popped up on the radar for that reason. Didn't have a lot of range, which I play stocks that time at times that don't have a lot of range, just because I like to try to get the pattern. I look for the pattern, and typically I've seen it more times than not hit the pattern. So in this particular trade, we had this nice massive run up, which I wait for a pullback. It pulled back here on the 5 minute, and then I look for, and I always tell people this is this transition. Something that I teach in my classes is this transition area. This is when I see the red candle engulfing the green, which indicates a reversal. So when I seen this reversal on a higher time frame, being the 5, not the highest time frame, because in the highest time frame it was still in a continuous upward motion. So any pullback on the 5 minute, any pullback on the 15 minute would ideally give you an indication or a place to actually get into the trade. So now that I know where my zone is, I zoom in on the 1 minute. Now these particular trades, these are what I call my sniper trades. These are the trades I take when, it's not a lot of action. I do see the pattern. I'm confident in the pattern. But moreover, I'm looking to get in small risks with a decent reward. So the stock didn't have a long range. I think the range on it was about 70 cents. I got about 42 cents on this. So when the stock pulled back and then confirmed on a 1 minute, I literally had about a 9 cent risk. So if you got a 9-10 cent risk with a 40 cent gain, you take it. That's a 4-to-1. That's a great trade. So it's not necessarily the dollar amount because 40 cent is still 40 cent. It can be 40 cent on 2,000 shares. It can be 40 cent on 20,000 shares. Whatever the case may be, it still turns out to be a decent day. And in particular, that was the trade that I placed and played on this day, and I got about 48 cents on this trade from entry to exit. So just to tell you that a lot of times it's not going to be a massive pullback. It's not going to be something that's on everyone's radar. This is just one of those easy trades, easy peasy. Got in, it started to reach out, and then once it started to pull, I ended up getting out of it like around the 1920s or so. The next trade that I want to go over with you guys is Lgvn. Now, this is one of those trades where everyone was looking at. So this is a well thought out trade. So when you look at this trade, you got to look at it from each aspect. Again, we see this 200-day moving average jumping over, had massive volume compared to the other days. So it's on everybody's radar. So when you have a stock that does that, first thing in the morning, you're looking at the price volume. You're looking at the volume being 1.5 million, and then the next candle after that on the 1 hour is 4.1 on the pullback. You got to start paying attention to that volume. So this is massive amount of volume coming in on the stock first thing in the morning. So just between these two candles, you got over 5 point something million in volume. Everyone's looking at this. So there's two things that can happen. You can get a nice play, a nice trade, or you're going to get a bunch of crowded movement going back and forth. This stock had a little bit more range than Flex, so I knew it had to give it some time to manifest where it needed to be. Now let's break this down into the 30 minutes so that you can kind of get an idea of what was going on. Now up into the first 30 minutes, the market opens at 9:30 Eastern Standard here. You got to look at the volume cues. You had 1.8, you had 2.5, you had 1.6, and then you had 1.5. So you got 1, 3, 5.5. So you had about 7, maybe 8 million worth of shares being traded just in pre-market. That's a lot of volume for a stock that hasn't traded that type of volume in days, if not weeks. So something was up. I looked at the news, seen that there was news on it. So there go a news catalyst, jumping over the 200 EMA. Now you're just waiting to see it set up a pattern for you. Now, I have a rule of thumb that I don't trade the first 5 minutes. Most of the people I trade with understands that. So when I'm looking at a stock first thing in the morning, I'm waiting to see what it manifests and see what it's going to do because I want the chart to tell me where it's going before I place a trade. Now, ultimately, the stock pre-market high was 983. When you trade as long as we have in our organization, you kind of wait for certain things. One thing I'm very aware of is that push into the pre-market high slam. This is something we've seen on GameStop, AMC, where AMC actually pulled it down, ran into pre-market high, and then they flushed it and slammed. This is that moment where they gather all the stocks, all the shares that they need, the market makers need to actually push the stock the way they want it to go. This is the reason why some people don't trade the first 10 minutes, 15, maybe even 30. I have some traders, people I speak with that don't trade the first hour of the trading day. They may not place a trade till after 10:30, 11 o'clock in the morning, once the stock has showed them where they're going. And the main reason for that, the secret is they want to see a high and a low entry day, not pre-market, but high and a low entry day to see that stock. Now, sometimes you do get that momentum of play that allow you to get into the stock first thing in the morning. But for me, it's just my trading style. I usually like to see an entry day setup. So I have everything else showing me that it has strength. Then I'm just waiting for the entry day setup. And then if you zoom in down to the 5 minute, take it down to the 1 minute so you can actually see this. This is the reason why I don't trade the first 5 minutes of the trading day. Because first 5 minutes, if we look at this, was 1, 2, 3, 4, 5 minutes. So just on the first 5 minutes, there was no structural pattern for me to see in the higher time frames, being the 15, 30, or 5, to show me where it was going to go. So it did this quick pop up to gather everybody interested, and then they slammed it, similar to that GameStop move that I showed you guys a week ago. Take a look at the videos then. You can see this pop up. They're going to pop it up, get everybody involved, and then flush it to gather all those, to hit all those stops. Because you got people who got in here, and they had stops back here. You got people who got stops back here. So they're looking for that push up to either add or just to flush it back down. So they flushed it back down. If we go back to the 5 minute, now we're starting to see the stock do a formation right here. And what I like to do is to see it engulfing. I like to see the whole candle being engulfed. What I mean by that is I like to see more body on the red candle and the green candle. So this was my first indication that this stock was probably going to go the opposite direction. So to kind of paint that picture, this is where price action, knowing the chart, paying attention to the play plays a part. This right here was your first area of interest. That maybe this is an area where there's some shorts getting in confidently. So you have to play out the trade in your mind and understand what both sides of the party is doing in real time. So we had this pushback that set a low. So now we got our high and we got our low. So that's been set for the day at this point. We see that they pushed the stock back up. Remember, then engulf. So this is just maybe a continuation. It pulled up into the key area, pre-market high. And then what did they do? They slammed it. But this was great. This is your first or second sign, I should say, of the shorts taking over. Now you got to remember how shorts trade. Shorts trade off pops. They like it to flush, push back up. This is the first pop, flush, push back up, pop, and then continue down. That's the type of pattern that they're looking for and looking for confirmation. So a lot of traders enter in here. A lot of traders, more advanced traders, they enter here, they enter in here. This is the same play. They entered in here and they entered in here. So because I got this pop, they're looking for a flush past this area here. This is the area of interest that they're looking for a flush. So they're looking for it to flush there to continue on for a downward movement. When traders look at this, they're thinking pop, pop, flush. They didn't get that. So now that they're not getting that, smart traders or shorters, they can break even or get out of the trade. It's very difficult to get out of the trade as it's squeezing against you. So a lot of traders set their stops a couple cent before, or they have a hard stop 20, 30 cent. The ones that really blow up their accounts, the ones that really get chopped up good, are the ones who set theirs around these key areas here or somewhere here, or sometimes on the level two, they'll see an area where there's a lot of selling at, and they might set it here. What happens is a lot of times they get pushed, and then it rapidly pushes them out of their position, and it's like stop hunting. They do it on both sides. So when you see the stock push back down and then it calibrated, this is a key area for me right here. So what I normally do is look for a pop, push, back, retest, and continue on. Because I've trade based on that, I usually place my stop somewhere back here. So this stock or this play, you would have placed your stop back here and enter in about here. Now that's one way of trading it. That is what we call an early entry. The second part of the trade will be at its peak or at its high. So what a lot of traders do, they wait for the high, or those higher day traders or breakout traders. Those traders essentially will wait for the higher zone. Higher zone being this higher 30-minute or the higher day. So you get a lot of traders that's getting in here, and they're using this as a zone or entry. They will get in off of this candle in the next 30-minute to wait for the actual break above 1013 is where they feel confident. Because at that point, pretty much all your shorts, if there's any, are starting to scramble to get out of the position. So it just depends on your trading style. You weather the storm, get out of this, and then it actually breaks. So there was a good entry here and a good entry here, depending on how you set your stops. Excuse me, with a lot of traders, and what I train is to add into a trade. So I would get in here with a small amount or half my position size. So let's say I wanted to do 1,000 shares on this stock fully. Okay, great. I'm going to enter in 500 here, and then I'm going to enter in here 500 here. So if it does come back, I lose, 30 cent. That's $150. In this trade, I lose $150 here, and then once I add 500 here, I'm probably somewhere around 985. As far as all my shares, 1,000, but the stock is already pushing away from my price, which gives me the confidence to let the stock trade and play out. Now that was your first entry. Now let's say you didn't see this or whatever the case may be, and you're looking for your second entry. Well, again, when you're looking for that second entry, you following along the same way. Um, when I'm looking at this stock, I look at those areas that are engulfing. You had your first entry here, or first area of interest when it pulled back on a 30-minute here, and it's showing that it's making lower lows, lower highs. So it's in a downtrend. So this will be considered a pullback. Now, it hasn't engulfed. And what I mean by that is I haven't seen it engulf to here. So what I mean is that the body on the open and close price is greater than the previous candle's open and close price. So this is engulfing this price. Yeah, some people want to see it wicked out or whatever the case may be, but this is what I consider engulf. So with that being said, I transition my lines to here. It's my support and resistance or my key area. So In that, I'm going to go down and look for an entry. So I'm waiting for it to set up. I got my high, I got my low, but I'm looking for, again, in a lower time frame, engulf. So we had one here, which is where it really took off and pushed it down. I see the next one right here. So this is very tight price action, which is what caused this explosion. So right there, you have to go down into the 1 minute to find your entry. So remember that those lines is very key areas. So this is where the stock kind of bounced. And if you look at it collectively, you can see the stock bounce, bounce, respected it, came back, bounce, hit this area, bounce back up to the key area, follow. Each one of these pops is where shorts got in. So they flushed it, pulled it back, went back, respected it, came back, congestion here, flushed it. So that's what created the second area. And then they used that same area to push everyone back out. So these key areas is where supply and demand areas of where the stock was um, getting its supply. So they supplied it here, bounced it, came back, and then it created a new demand area that they pushed away from. So if you didn't get in on the first set, you can always get in on the second set if it's a continuation. The biggest thing that most traders do is not be patient with their trades. And this is the reason why they end up getting chopped out or they end up having bad trades. And over time that erodes at your confidence in trading. So the key to it all is waiting for your setup, waiting for the idea that you're looking for on how you trade, and then place that trade. Even if you use this area, you could have used this area as a zone because of the pullback. And let me show you how you trade off of there. Remember, you got your high and your low in this zone. The stock broke down from the zone and then returned. Whenever I see a stock break down from a zone and return, that's just a good indication that they were trying to get more shorts involved to trap them, to get them pushed out. Now, again, you looking for those zones. So your first area of interest where it engulfed was here. So when I saw that it engulfed here, that's my first area of interest to play that trade right here. So this could be your C area. Once it broke out, it returned, which you probably see on the 1 minute. Breakout, return. Now it depends on if you got into the trade here, anticipating because you had a nice little break off of here. You might have played it off of here, risking to here. I mean, that literally would have been 20-cent risk. So you're looking for that. It yanked up, pulled back. Remember, you risked to here because it's the swing. Pulled back, and then it just catapulted. Now, some traders would have waited because it was a key area. They like to see it test and then either join a trade or play in a test. It pulled back, test, and then they played in the trade. So even if you risked off of here, this was only a 40-cent risk to the previous low. It broke out and kept going. So these are the things that you want to look at in trading to break down a trade and wait for those different areas of setups to give yourself an opportunity, a real opportunity to actually place that trade and get into a trade. So something to think about. But guys, if you have any questions, leave them in the comments section. Hit that bell and subscribe if you like the video. Hit the like symbol. Subscribe so that you can get the new videos as they come. But if you have any questions, concerns, I'm always here to help. But as I always tell everyone, stay studying and stay focused.